Hi, I'm Yuan, head of Group 4. I'm going to introduce the financial statement of Mars Company. As a civil engineering student, my ultimate goal is to become a licensed professional structural engineer and work in an infrastructure company. While my technical skills are essential for achieving this goal, I have to recognize the importance of developing a strong financial management ability that will enable me to effectively manage a project's budgets, analyze the financial data, and make the profitable decisions. Firstly, we will focus on the balance sheet. The four pie charts provide information about the company's assets, liabilities, and equity. From these charts, we can see that the percentage of the four items has remained relatively stable over the 4 years period. However, in the following line column combo chart, we can see that the value of the total asset and the total liabilities has little fluctuated but goes a decline trend over the 4 years period. Fortunately, the long-term liabilities has decreased every year. Moreover, the equity has remained consistently stable throughout the 4 years period. Overall, these trends provide valuable insight into the financial health of the Mars company. The Mars income statement also shows fluctuated over the 4 years, with the fluctuation in the sales, gross profit, EBIT, EBT, net income, and dividends. Although our company has been able to decrease the COGS expense over the 4 years, its net income has been notably impacted by the fluctuation in its sales and its gross profit. However, the 4-year sales of Mars company show a overall downward trend, which also leads to the reduce in the net income. Especially in 2020 and 2022, it shows a big decrease. Despite this, Mars company has maintained this commitment to its shareholder by paying out the dividends, while also setting some aside retained earnings for the future investments. According to the income statement for the years at the end of 2022, June 30, we could see that the sales of the Mars company up to 777 million, but the cost of the COGS also takes the major part of the expense. At the end, the net income was just 97.75 million. The cash flow from operation increased from a negative amount of 18.8 million in 2020 to a positive amount of 216.8 million in 2021, and then decreased to 11.6 million in 2022. This indicates that the Mars company's operations generated positive cash flow in 2021 and negative in 2020 and 2022. Similarly, the cash flow from financial was negative in the 3 years but raised in 2021. By contrast, the cash flow from investing kept in zero. Overall, the net cash flow was negative in 2020 and 2022, which means our company used more cash than it generated, but it's positive in 2021. That means our company saved more cash than it used. The following is a year-to-year change line graph. You could see almost all value except from long-term asset and long-term liability are fluctuated in the 4 years. Like the gross profit rose from negative 50/100 in 2020 to positive 100% in 2021 and fell into negative again in 2022. That is worth mentioning the EBT, EBIT, and net income. The EBT kept in same change with the net income in 4 years, which raised from negative 88% in 2020 and rocketed to 522% dramatically in 2021, and then it down to negative 87.5% in 2022. Compared to them, the EBIT was changed later, although the value is high to 84% in 2021. The changing trends of the horizontal analysis of the balance sheet is similar to the year-to-year change, although they don't have any relationship. In this part, almost all values are below zero because which means almost all of the income statement value are worse than the base year 2019, and the fluctuated of the income statement are very huge, which ranged from 0 to negative 90.67%. Similarly, the trend is also remains in vertical analysis, which declined in 2020 and raised in 2021 and dropped again in 2022. It is worth mentioning the COGS and the total long-term asset have the highest rate in the income statement as well as the balance sheet. That means taking some measures to decrease the COGS might be our first priority in the next years. According to the part 1, which I presented of the financial statement analysis, we could conclude that the 2019 and the 2021 are the golden year for the Mars company, which created the huge net income for our company and big dividends for our shareholders, although the 2022 and 2020 was just a smaller income. They were also profitable years. Moreover, luckily, in the balance sheet, that shows there have abundant assets in our account. Although our profitability is declining, that means we still have some chances to do something to change that.
I'm a student majoring in finance and human resource management for my undergraduate degree and engineering management for my master's degree. Currently, I'm studying financial management, which is significant as it equips me with the knowledge and skills to manage financial resources effectively, make informed investment decisions, and understand the financial implications of business decisions. It also helps me to develop a strategic mindset and analytical skills, which are essential in today's competitive business environment. The financial ratio of Mars company reflects a mixed picture. The liquidity ratio shows a declining trend, with the current ratio decreasing from 1.19 in 2019 to 0.99 in 2022. The profitability ratio also shows a decline, with the operating profit margin and the return on assets decreasing significantly. The company's debt ratio remains high, but it has decreased over the years. The asset turnover ratio shows a mixed trend, with inventory turnover decreasing and the receivables turnover increasing. The market value measures show a decline in earnings per share and the dividend per share, but the market-to-book ratio has increased. Overall, the company needs to focus on improving its liquidity and the profitability ratio while reducing its debt ratio. Mars company's enterprise value has been fluctuating in recent years, with a peak of 8,160 in 2021 and a decrease to 4,840 in 2022. The market value of equity has also been fluctuating, with a decrease in 2022. Possible reasons for this could be changes in market competition or internal issues within the company. It is important for Mars to analyze the reasons for the fluctuations and make necessary adjustments to ensure future success. This could include improving operation, investing in new products or technologies, or adjusting marketing strategies to better reach consumers. The data shows the free cash flow to firm and the free cash flow to equity for Mars company from 2019 to 2022. The FCFF shows a significant increase from 2019 to 2021, indicating that the company is generating more cash from its operations. However, the FCFE shows a negative value in 2019 and 2021, indicating that the company is not generating enough cash to pay its shareholders. The data also shows that the company has been borrowing money to finance its operations, which could be a cause for concern. Overall, the data highlights the needs for Mars company to focus on generating more cash from its operations and reducing its reliance on borrowing. Mars company's economic value added has been fluctuating over the years, with a significant drop in 2020 and a slight recovery in 2021. The company's return on invested capital has also been declining, indicating a decrease in profitability. However, the company's market value added has been steadily increasing, indicating that the investors have confidence in the company's future growth potential. This data highlights the importance of considering both financial and market performance when evaluating a company's overall success. Mars company may need to focus on improving its profitability to maintain investor confidence and sustain long-term growth. The ultimate Z-score is a measure of a company's financial health and the likelihood of bankruptcy. Mars company's Z-score has been fluctuating over the years, with a significant increase in 2021 and a decrease in 2022. The Z-score indicates that the company is currently in the distress zone, which means that it may be at risk of bankruptcy. This data highlights the importance of monitoring a company's financial health and taking corrective measures to avoid bankruptcy. Mars company may need to focus on improving its financial performance, reducing debt, and increasing profitability to avoid bankruptcy. The company may also need to consider restructuring its operations or seeking external financing to improve its financial position. Overall, the ultimate Z-score is a critical tool for evaluating a company's financial health and identifying potential risks.
Hello, I'm Yu Hao. From this picture, we can see the loan amortization at 8% of interest rate. We can see the size of annual installment, the total repayment over the term of the loan, and the total interest payable. Right here, we can see the loan repayment schedule. In the case of the limited, paid the first 3 installments and could not pay the 4th installment. In the case of the effective annual interest rate increases to 32% after 3 years. We calculate the extended number of future repayments and create a loan repayment schedule for the 5th and 6th periods of the loan. If we assume the effective annual interest rate increases to 12% after 3 years, the number of future repayments is 4.47. When the limited got a loan of 5 million from the bank, we calculate the size of monthly installment, the total repayments, and the total interest payable, and create a loan repayment schedule for the loan. At the end of the year 5, we also calculate the above amount. In the case of some installments are not paid and the case of change in interest rate, we calculate the increased payment and create the loan repayment schedule. When the limited issued the bond with a face value of $2 million and the rate is 8%, we calculate the annual coupon payment and the bond price. The bond is trading at discount. The price over time is increasing. The current yield is about 9%, smaller than yield to maturity. The capital gain yield is about 0.88%, smaller than yield to maturity. When the limited issued a bond for $40,000 with a face value of $50,000, the annual coupon payment is $4,000. The yield to maturity is about 11%. The bond is trading at discount. Current yield is 10%. Capital gain yield is 1.11%. When the limit issued a 0 coupon bond with a face value of $80,000 that matures in 7 years and the yield to maturity is 9%, the annual coupon payment is 0. The current value of this bond is $43,762. The bond type is par. Price over time is increasing. The current yield is 0%. Capital gain yield is 9%. In the given situation, the degree of operating leverage, financial leverage, total leverage of Mars Limited at a volume of sales of 30,000 and 40,000 marks are here.
This is Applied Financial Management Group 3, Mars Corporation final presentation. This is my personal profile. My name is Jian Liang, and my ID is 246766266. And this is the first slide. Based on Modigliani and Miller proposition, the unlevered firm value can be calculated by diving the earning after tax by return on equity Based on the problem, the earning before interest and tax is 1 million. The unlevered firm doesn't include the value of debt, hence interest expenses will not reduce the value of EBIT. EBIT will reduced by 30% tax to get the earning after tax of 700,000. Lastly, the 700,000 will divided by return of equity of 8% to get the unlevered value of firm of 8,750,000. For the levered value of firm, the tax shield brought by debt will add up to unlevered value of the firm. The tax shield is 1,800,000, which is calculated by multiplying the 6 million debt by 30%. Lastly, add up the unlevered value of the firm, which is 8,750,000 by 1,800,000 tax shield to come up with 10,550,000 levered value of the firm. To estimate the value of the equity, reduce the levered value of the firm, which is 10,550,000 by 6 million worth of debt to get 4,550,000. The next slide. To get the $400 market value of assets, just add up the market value of the debt. $300 and market value of equity $100. The weight of debt and equity can be calculated by dividing each market value by the market value of the assets. To calculate the cost of debt after tax, it will begin on calculation of cost of debt before tax. The cost of debt before tax can be calculated by multiplying the weight of debt to its rate, which is 7 and 5%, multiply 10% and will result to 7.5%. Then remove the 30% tax portion of 7.5% by multiplying by 70% to get cost of debt after tax of 5.25%. The pre-tax WACC is calculated by multiplying the weight of cost of equity to its rate, which is 25%, multiply 14% and will result to 3.5%. Then add up by cost of debt before tax of 7.5% to get 11%. Finally, to get the cost of debt after tax, add the cost of debt after tax of 5.25% to get 3.5% to get 8.75%. And the next slide. The market value of debt is based on the book value of debt 254.545 multiplied to its trading percentage, which is 110%. For the market value of equity, multiply the number of outstanding shares 20 million by trading price per share of $6. The calculation of market value of assets, weight of debt, weight of equity, after-tax cost of debt, pre-tax WACC and after-tax WACC can be calculated in reference on the previous slide. The next slide, the market value of assets is calculated by adding up the market value of debt, preference shares and common shares. The calculation of respective weight is based on the market value of assets as the base. The calculation of pre-tax WACC and after-tax WACC can be calculated in reference on slide 2. The next one, the table shows the cash flow per year related to the project. The cumulative cash flow is calculated by adding up the cumulative previous year's cash flow to current year's cash flow. Finally, the discounted cash flow and cumulative cash flow is based on the cumulative cash flow. However, it was discounted by 10%, discount rate to get the present value. The last one, the various capital budget metric on the right are calculated based on the cash flow table on the left. The NPV measures the positive cash that we'll earn after reducing the discounted cumulative cash flow by cost of investment. The IRR measures the proper discount rate based on the series of cash flow, and the payback period measures how long the project will recover its cost. That's all.